Hello students, I hope you are enjoying our video. If you want to see more videos like this, please do not forget to like, share and subscribe our channel. Students, let's have a look at another chapter which is called Job Order and Batch Costing. Concept of job order costing. The act of producing goods and providing service according to the special demand or order of the customer is called job. Now it becomes necessary to ascertain the total cost of the job. Hence, the process of ascertaining the cost of job is called job order costing. This technique can be used by repair workshop, tap and electricity connections, research center, construction companies, advertising agencies, auditing firm and other non-manufacturing organizations. Under this method, costs are accumulated for each job or work order separately. The jobs are usually carried out inside the factory building and complete in short span of time. They can easily be distinguished from each other. Chartered Institutes of Management Accounting, CIMA, London defines job order costing as that form of specific order costing which is applied where work is undertaken to customers' specific requirement and each order is of comparatively short duration. The work is usually carried out within a factory or workshop and moves through process and operations as a continuously identifiable unit. The term may also be applied to work such as property repairs, and the methods may be used in costing of external capital expenditure job. The main features of job order costings are as below. In job order costing, each job is treated as a cost center. The cost of each job is determined after the completion of the job, but cost estimations of each job is made according to the past experience. The legal cost of job is determined by adding materials, labors and overhead cost. Each job order is given a job number and costs are accumulated with reference to this number. Then total cost of each job order is ascertained. The total cost are price charged for each job are compared and profit or loss made by each job is ascertained. The duration of job is comparatively short, so work in progress may or may not exist at the end of the accounting period. Objectives of job order costing. The main objectives of job order costing are presented below. To calculate the cost of each job by maintaining a separate account for each job or order. It enables the calculations of profit or loss for each job order. It helps the management in estimations or quoting the price for an order or job. Such estimations are made on the basis of past cost records related to the similar work. To help identify the profitable and non-profitable job or order. To differentiate the cost of every job or job order and production from one department to other. To compare actual cost and estimated cost for purpose of controlling the operational inefficiency. Advantages of job order costing. It provides a detailed analysis of cost of material, wage and overheads classified by functions, departments and nature of expenses, which enables the management to determine the operating efficiency of the different factors of productions, production centers and the functional units. It helps to ascertain the cost of production. It enables the management to identify profitable and non-profitable job or order. It helps the management in formulations of plans and policy related to the production and distributions. It helps the management in estimations and quoting the price for an order of a similar job. Such estimations are made on the basis of past cost records. It also helps in controlling the material and labor cost. It also provides information about various aspects of cost. Disadvantages of job order costing. It is based on historical cost. The cost of job order is ascertained after the work is completed. Hence, there is no possibility of adjusting the unnecessary material, labor or procedure. It is expensive since separate records has to be maintained for separate job or order. It is difficult to calculate the exact cost of job if there is no effective system of separating the cost into direct and indirect. This method may not be suitable for job that includes high cost and time. A procedure of job order costing. The following procedures are involved in job order costing. First, inquiry from customer, then cost estimations, and thirdly, receiving orders. Fourth, production orders, measuring of direct material, direct labor, and manufacturing overhead cost. Direct material cost, direct labor cost, and manufacturing overheads. Generally, a job order cost sheet is a document which is used to record productions of a job received from customer. It is a document of cost designed to show the total cost and unit of cost of each job in an analytical and detailed form. In other words, a job order cost sheet is a document detailing the cost of the job under direct material, direct labor, manufacturing overheads, administrative overheads, and selling and distribution overheads. It is prepared for each specific job, not for a specific period. It is also known as job cost card. The total number of unit production is 100,000 units. There is a heading given: raw materials, direct labor, manufacturing overhead, and fixed cost. And requirement is calculate cost of job number 101 and determine the price given profit of rupees 25 on selling price. So we are given here department A, B, and C, but for the raw material there is only department A and C, and their unit is given below. So now let's solve this problem one by one. Firstly, let's take the heading here: job cost sheet of company. Then we know that job order number is 101 is given here, job order number is given here 101, and over here it is given date of completion. This is quite big and calculative process. So there is a three column here: material, labor, and manufacturing. So simply jot down all of the information in the answer sheet. So department A, we are given here department A for raw material 2000 units, rate is rupees 1 per unit, and the amount is unit multiplied by rate. So we get here is 2000 rupees. And department B, for the material there is no department B, so let's have a look at department C. So department C is 105 units, 1005 units, rate of unit is 2. So simply multiply these two, we get 2010. Now let's go to labor. Three department A, B, and C. Labor, department A is 60 hour, rate is 3 rupees per hour, so that means 180 rupees. Similarly, department B is 40 hour, rupees 2, so it is 80. Department C, it is 20 hour, then 5 rupees. In this way it is 100 rupees. Manufacturing overhead, again department A, B and C. Department manufacturing overhead in a variable department, this is variable. So for the manufacturing overhead, we are based the rate the hours is based on direct labor. So department A is 60 hour, it is 40 hour, and it is 20 hour. The rate is we need to calculate here. Department A total amount is 5,000 and labor hour is 500. So let's divide 5,000 by 500. We get it is actually 5,000. 5,000 divided by 5,000, we get here rate is 1. Then let's divide 3,000 divided by 1,500, we get the rate is 2. And in department C, we look here as a amount is 2,000 divided by 500 is 4. Then amount is given here is a 60 into 1 is 60, 40 into 2 is 80, and 20 into 4 is 80 again. Now the fixed cost under manufacturing overhead. So for the fixed cost, the total hour is, we have to add all of this hour, the direct labor hour, which is 60 plus 40 plus 20, and we get here 120. Again, to calculate the rate, we have to divide the estimated rupees fixed cost estimated at rupees 2,000 for 10,000 normal working hour. So that means fixed cost per day rate is 1,000 divided by 10,000, we get value as 0.2. So 0.2 multiplied by 120, we get here as 24. So let's make it total here. How much we get here? 4010. Total here amount is 180 plus 80 plus 100, 360. Then for the manufacturing overhead, the amount would be 60 plus 80 plus 80 plus 24, we get 244. Now finally we have to calculate another here, which is known as summary of cost sheet. Direct material, we know that direct material the value is rupees 4010. Direct labor is 360. Then manufacturing, these two are known as prime cost. So 4010 plus 360, you get value as 4370. Then we add manufacturing overhead. Manufacturing overhead is 244. plus 244 4614. This is known as factory or work cost or total manufacturing cost. Then we add the profit. The profit percentage is over here given as calculate cost of job order cost, determine the price given profit over 25% selling price. So we add 25% selling price. So 4615 25 is we get a as a 4614 25 divided by 75, then we get value here is 4614 multiplied by 25 divided by 75, we get value as 1538. So altogether sales price is given here is plus 4614 6152. So selling price per unit is, we know that the total number of production is 1000 unit. So selling price per unit is 1615 divided by 1000, we get here is 1.152 rupees as a selling price per unit. Now let's have a look at the batch costing. Concept of batch costing. According to the Institute of Cost and Management Accounting, ICMA London, batch costing is that form of specific order costing while applies where similar articles are manufactured in batch either for sale or use within the undertakings. Batch costing is similar to the job costing, as each batch of output is cost units and costing is done separately, just like costing of job is done separately. However, each batch consists of number of identical units of products, so that total batch cost divided by number of units produced in batch gives cost per unit. In case of job, production is to satisfy a specific order and not for stock. So feature of batch costing: each batch is cost unit. All units produced as part of batch are identical. Costing of each batch is done separately. Each batch generally involves a set of cost, and set of cost for each batch is more or less same irrespective of size of the batch. Batch production is generally for stock. Higher the size of the batch, lower the cost per unit. Larger the batch size, longer is the time interval between batches. Cost per unit may differ in case of different batches, though the size of the batch is same because of changes in production conditions and input costs. The method is used where small parts are produced in significant large number. The advantage of the method is that cost and profit per unit can be known without preparing cost sheets for units, but by determining cost of the batch as a whole and dividing it number of units constituting the batch. Annual demand of 6400 units. Setting up an ordering process cost is rupees 100. Cost of production per unit is rupees 40. Rate of interest per annum is 20%. Number of days in the year is 360 days. So required economy. So we will solve one by one here. Firstly, it is asking to solve as economic batch quantity in short EVQ. Formula for EVQ is uh, 2AS divided by C. So we are given here annual demand, which is A is equal to annual demand is given as 6,400 units. Then setting of cost or S is given as setting of cost is rupees 100. Then carrying cost is rate of interest burden is 20%. So that means cost of production per unit is 40 and rate of interest per annum is 20. So that means carrying cost is 20% of rupees 40. So that means rupees 8. So let's put all of this value in the formula. We get here 2 annual is 6,400, S is 100, then divide by rupees 8. We get here value as 2 multiplied by 6,400 multiplied by 100 divide by 8, and we square root. We get here 2 multiplied by 6,400 100 and rupees 8 is 160,000. The square root is square root is 400. And in second, minimum average year cost. Minimum average yearly cost formula is 2ASC we know that value as annual is 6,400 and S is 100 and carrying cost is obviously we know 8. We get the value here is 2 multiplied by 6,100 multiplied by 100 multiplied by 8. We get value is 10241234 square root. We get as a rupees 3,200. Another question we are asked, optimum number of setup optimum number of setup per annum. Formula is A divided by EVQ. We know that A is 6,400 and EVQ we just calculated earlier is 400 here. So simply 6,400 divided by 400, we get value as 16 setups per annum. And lastly, it is asking optimal period of production. Optimal period of production formula is number of days in year divide by optimum number of setup. Number of days in a year is 360, and the optimum number setup we just calculate here 16. So let's calculate, divide 360 divided by 16, we get value as 22.5 or 23 days.